US says it sinks Iranian small boats, shoots down missiles, drones as it opens. The leverage shift starts now. Here is the signal that separates noise from actionable change. We will map trigger, incentive shift, and downstream impact before the close. The US Navy destroyed 6 Iranian speedboats and shot down multiple missiles and drones near the Strait of Hormuz. This is not a minor skirmish. Here's why it matters and what changes next. First, understand the stakes. The Strait of Hormuz is the world's most critical choke point for oil and gas. Roughly 21 million barrels of oil flow through it every single day. That's about 1/5 of global oil consumption passing through a 21-mile-wide corridor. When tensions spike here, energy markets respond instantly. Oil prices move. Shipping insurance costs jump. Companies recalculate supply chains. This escalation creates immediate friction in global energy flows. The US response is significant because it signals a hard line. These weren't warning shots or defensive maneuvers. The Navy actively sank Iranian boats and intercepted airborne threats. That's a show of force designed to establish boundaries. Iran's message, by attacking in the first place, was equally clear: the US presence here is contested. Now both sides have raised the stakes on messaging. What this means for markets is concrete. Oil prices are already volatile. A prolonged standoff in the Strait would push crude higher and create immediate pressure on fuel costs, shipping rates, and ultimately inflation. For countries importing energy, India, Japan, South Korea, Europe, this creates real economic friction. The Indian rupee, already under pressure from dollar strength, could face additional headwinds if oil stays elevated. For investors, this is a geopolitical risk premium that just got priced in. But here's the second-order effect nobody's talking about yet. These incidents force companies to rethink choke point dependency. Major shipping firms are already exploring alternative routes. Some oil flows are being rerouted around Africa, which is slower and more expensive, but reduces exposure to the Strait. This accelerates a long-term shift in global logistics. Companies that can reduce their exposure to high-risk corridors will do so. That means investment in alternative infrastructure, pipelines, rail, different shipping lanes. The Suez Canal crisis 2 years ago taught this lesson. Now the Strait of Hormuz is getting a refresher course. For AI and tech companies, the implication is operational. Data centers require stable power. Crypto miners absolutely depend on cheap energy. If oil prices stay elevated or volatile, electricity costs rise across the board. Companies with exposure to energy-intensive workloads will face margin pressure. That includes cloud providers, semiconductor manufacturers, and any firm running large AI training operations. A sustained supply shock here flows directly to operational budgets in tech. The contrarian angle: this might be temporary. Escalations in the Strait have happened before. The 2019 tanker attacks created headlines but resolved. Markets have absorbed multiple Iran-US confrontations over the past 5 years. The initial shock will fade once the market prices in either a de-escalation or a new baseline of tension. That's when the real winners and losers emerge: those who hedged, those who diversified, and those who bet on stability. What to monitor over the next 72 hours: oil prices, shipping indices, currency moves in the rupee and other emerging market currencies, and any official statements from Iran or the US about further action. If either side backs down, markets stabilize quickly. If rhetoric escalates further, expect energy prices to move higher and volatility to persist. This is a live signal that demands attention. It's also a reminder that geopolitics and markets are inseparable. One military action in a 21-mile-wide strait can ripple across global energy, inflation, and tech operating costs. Watch how your portfolio responds. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next. Watch the execution timeline, second-order market effects, and policy response to gauge what happens next.